PepsiCo might not make headlines like AI stocks or tech giants, but it quietly generated over $90 billion in sales last year, pays a growing dividend, and has increased payouts for more than 50 consecutive years. The real question is, with slowing growth, rising costs, and changing consumer trends, is PepsiCo still a safe, long-term investment, or is it time to rethink? The first Pepsi soda was created in 1898 by a pharmacist in North Carolina, inspired by Coca-Cola's recent success. The drink quickly gained popularity, and in 1902, the Pepsi-Cola company was officially incorporated. Today, PepsiCo is a global leader in various snack and beverage categories and boasts more than 20 brands that each generate over $1 billion in sales, including Fritos, Gatorade, Mountain Dew, Quaker, Lay's, Cheetos, Bubbly, Aquafina and Rockstar. The company is currently available with a 4.25% starting dividend yield, compared to its 5-year average of just 2.89%. The price-to-earnings ratio is currently only 16.8 versus the 5-year average of 23.7, while the sector average is around 17.8 at the moment. The stock price is currently near the bottom of its 52-week price range. The expected price range is estimated to be between $170 and $208, while the stock is currently trading at around $133, making it appear significantly undervalued. The company is currently paying an annual dividend of $5.69, distributed on a quarterly basis. The next dividend payment is scheduled for September 30th, and shareholders who own the stock by September 8th will be eligible to receive it. The most recent dividend increase was 5%, compared to a 5-year average of 7% and a 10-year average of 7.7%. Additionally, the company has been paying dividends for 60 years and has increased its dividend for 52 consecutive years. The earnings payout ratio fluctuates around 70%, and based on expectations, it is projected to be around 71% over the next 12 months. This is considered relatively high, but similar levels have occurred before without causing long-term issues for the company. However, it's worth noting that the company is paying out a higher percentage of earnings today than it did a decade ago, which could be a warning sign that future dividend increases may be smaller. The free cash flow payout ratio has also remained quite elevated for years. Looking at the earnings per share chart, it's clear that the company's growth has gradually slowed down, with a slight downward trend starting to emerge. Free cash flow per share has been stable around $5 for years without showing meaningful growth. Both the earnings per share and sales growth charts reflect this slowdown, but I wouldn't draw any long-term conclusions after just a few weaker years, especially with a company of this size. This could be a sign that there's limited room left for further growth, but it might also represent an excellent buying opportunity at current levels, especially with such a high dividend yield. The company maintains a regular share buyback program, which is a positive sign for long-term investors, just like the fact that total sales remains in an upward trend. Return on equity and return on invested capital have consistently exceeded expectations over the past decade. The operating margin chart, however, looks far less impressive and could still benefit from further optimization, especially as free cash flow margin is in a clear downward trend. While margins still exceed sector minimums for now, if this trend continues, it may not stay that way for long. As for debt, there are no major concerns. Management is careful not to overextend financially, and interest coverage remains comfortably above expectations, although it was somewhat volatile during the latter half of the 2010s. The company is currently available with a 4.25% starting dividend yield, which seems like a rare opportunity. The most recent dividend increase was 5%, and the company holds a strong A+ credit rating. The dividend also appears to be very safe, suggesting that the stock may be significantly undervalued at current levels. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Q1 headline results. Revenue $17.9 billion, down 1.8% year over year. Core EPS $1.48, down 4% constant currency. GAAP EPS $1.33, down 10% year over year. Organic revenue growth plus 1.2%. CEO Ramon Laguarta highlighted that consumer demand remains subdued, supply chain costs are rising, and trade risks are growing. As a result, full-year EPS guidance was cut, now expecting flat EPS year over year, previously mid-single-digit growth. Dividend increased by 5%, continuing PepsiCo's 53rd consecutive annual increase. Where is PepsiCo growing and where is it struggling? PepsiCo Beverages North America plus 1%. Slight recovery. PepsiCo Foods North America minus 2%. Weak volumes. International Beverages franchise plus 7%. Solid growth, Europe, Middle East, Africa, plus 8%. Strong price mix, Latin America Foods, plus 3%. Rebound, Asia Pacific Foods, minus 1%. Flat slight decline. Operating profit weak in North America, stronger internationally. Cash flow from operating activities minus $973 million this quarter, seasonal but still weak. Dividend payout $1.88 billion in Q1. Debt. Long-term debt rose from $37.2 billion to $39.4 billion. What PepsiCo expects? Organic revenue, low single digits. Core EPS, flat versus 2024 FX headwind, approximately 3% drag on results. $8.6 billion total cash return to shareholders in 2025, of which $7.6 billion dividends. So, what's the takeaway? PepsiCo's 2025 story is simple. This is still a cash flow machine, still a dividend aristocrat, but it's not a growth story right now. North America is clearly struggling with soft demand and higher costs. Meanwhile, international markets are keeping the ship stable through price increases and better margins. PepsiCo's management is realistic. They're not promising fast growth, but they're delivering reliability through productivity initiatives and cost control. If you're here for dividends and stability, PepsiCo remains attractive. But if you're looking for fast earnings growth or exciting catalysts, this might not be your stock right now. Ultimately, PepsiCo continues to play defense well. Whether that's enough depends on your investing goals. Alphabet just reported over $90 billion in revenue in a single quarter, and net income up 46% year over year. But here's the real question. Is Google's AI empire just getting started, or are we already too late? Because while the headlines scream about record profits, the real story is unfolding behind the scenes. AI infrastructure, cloud growth, YouTube's slowdown, and Google's $17 billion bet on the future. In this video, we're breaking down exactly how Alphabet is making its money, where it's headed, and whether the stock still makes sense in 2025, based on both fundamentals and long-term strategy. Founded in 1998, Alphabet is a tech giant primarily known for its Google services. It earns revenue mainly through digital advertising on platforms like Google Search and YouTube. The firm also sells apps and digital content via Google Play. Google Cloud represents another key driver and provides businesses with computing power, data storage, and digital software tools through its network of data centers and server farms. The company is currently available with a starting dividend yield of 0.47%, compared to its 5-year average of 0.48%. The price-to-earnings ratio is currently 19.4, while the 5-year average stands at 21.9 and the sector average is 18.1. The expected price range is estimated to be between $183 and $224, while the stock is currently trading around $180, suggesting it appears to be undervalued based on these figures. The company currently pays an annual dividend of $0.84, distributed on a quarterly basis. The next dividend payment is scheduled for September 16th, and shareholders who own the stock by September 9th will be eligible to receive it. The earnings payout ratio has averaged around 10%, and it's true that most investors don't hold this company primarily for its dividend. The free cash flow payout ratio is also very low, so a dividend cut is highly unlikely. Earnings per share has been following a steady upward trend. Although there was a dip in 2022, it has since returned to a growth trajectory. The same can be said about free cash flow. Over the past 3 years, earnings per share has shown very strong growth, and the same applies to the sales growth chart. However, expectations for the next 12 months indicate only around 3% growth. The shares outstanding chart has been on a steady downward trend for years, while total sales continues to show consistent growth despite the shrinking share count, something investors generally love to see. Both return on equity and return on invested capital are well above minimum expectations and remain stable. The same can be said about operating margin and free cash flow margin, although with Google, this hardly comes as a surprise. The company's debt management is excellent. Both the net debt to EBITDA and net debt to capital charts have effectively been at zero for the past decade. It's no surprise, then, that interest coverage significantly exceeds expectations as well. The company is currently available with a starting dividend yield of 0.46%, which was recently increased by 5%. Its credit rating is AA+, which is considered very strong. The dividend also appears to be secure. The company appears to be very slightly undervalued. Let's start with the numbers. In Q1 2025, Alphabet generated $90.2 billion in revenue, up 12% from the same quarter last year. That's an increase of nearly $10 billion in just 12 months. Operating income came in at $30.6 billion, representing a 20% year-over-year increase. And net income soared to $34.5 billion, up a staggering 46%. Diluted earnings per share rose from $1.89 to $2.81. That's a 49% jump. Visually, you can see this growth on the revenue and operating income chart. Revenue jumped from $80.5 billion to $90.2 billion. Operating income climbed from $25.4 billion to $30.6 billion. And the operating margin improved from 31.6% to 33.9%, showing not just growth, but more efficient profitability. Now let's look at costs. Cost of revenues increased by 8% to $36.4 billion. R&D expenses rose by 14% to $13.6 billion, showing continued investment in innovation. Sales and marketing actually declined by 4%, down to $6.2 billion. General and administrative costs increased 17% to $3.5 billion. Despite higher spending in some areas, Alphabet kept overall cost growth in check compared to revenue growth. When we break it down by segment, Google Services, which includes search, YouTube, and network ads, generated $77.3 billion in revenue, up from $70.4 billion a year ago. Google Search and Other, $50.7 billion, up 10%. YouTube ads, $7.3 billion, down 2%, possibly reflecting ad market softness. Google Network, $8.9 billion, up 10%. Subscriptions, platforms and devices, $10.4 billion, up 19%. The segment's operating margin improved from 39.6% to 42.3%, showing strong profitability. Meanwhile, Google Cloud continues to impress. Revenue rose from $9.6 billion to $12.3 billion, a 28% year-over-year growth rate. Operating income more than doubled, jumping from $900 million to $2.18 billion. This pushed Cloud's operating margin up from 9.4% to 17.8%, signaling scalability and improving profitability. Alphabet is also investing heavily in its future. Capital expenditures hit $17.2 billion, up from $12 billion a year ago, a 43% increase. These investments are primarily going toward AI infrastructure and data centers, showing Alphabet's aggressive push into artificial intelligence. And despite these major investments, Alphabet still generated $18.95 billion in free cash flow for the quarter. Trailing 12-month free cash flow is now sitting at $74.9 billion, one of the strongest in the entire tech sector. Just to put it in perspective, Operating cash flow for the quarter came in at $36.1 billion, even after subtracting $17.2 billion in capex, leaving the company with an enormous cash cushion. Alphabet is funding AI expansion, cloud growth, and long-term innovation entirely from internal cash flows, with no need for heavy debt or dilution. So to sum up the quarter, record high revenues, accelerating cloud profitability, massive AI infrastructure investments, and industry-leading free cash flow. Alphabet continues to operate from a position of financial strength, and Q1 2025 shows that they're scaling profitably across all major business units. Pfizer was once one of the biggest winners of the pandemic, but today the stock is down, growth is slowing, and investors are starting to ask, is this a hidden opportunity or a value trap? Pfizer, founded in 1849, develops prescription drugs and vaccines for a wide range of diseases and conditions. Key products include Eliquis, a leading blood thinner for preventing strokes, and Ibrance, a cancer treatment for advanced breast cancer. The firm also produces a COVID-19 vaccine and an antiviral treatment. Pfizer generates revenue through prescription sales and invests heavily in research and development to drive innovation in areas like oncology, rare diseases, and mRNA technology. The company is currently available with a dividend yield close to 7%, while the 5-year average was only 4.2%. The price-to-earnings ratio is 8.5, compared to a 5-year average of 11.1, while the sector average is currently around 15.6. The expected price range is between $29 and $35, while the current share price is $24.61, making the company appear significantly undervalued. The company pays an annual dividend of $1.72, distributed on a quarterly basis. The next dividend payment is scheduled for September 2nd, and shareholders who own the stock by July 25th will be eligible to receive it. The most recent dividend increase was 2.4%, compared to a 5-year average of 3.1% and a 10-year average of 4.9%. It's clear that the company is raising its dividend at a slower pace, which isn't surprising given the already high starting yield. Of course, this also suggests that no significant revenue growth is expected in the near future. Following the 2008 financial crisis, the company also cut its dividend, so it has currently only been raising dividends consistently for 14 years. The earnings payout ratio is still within acceptable levels at the moment, but expectations for the next 12 months are already around 60%. The free cash flow payout ratio is showing a nice downward trend, and it could potentially drop below 60% as well. However, the company urgently needs to either grow its revenue or slow down the pace of dividend increases if it wants to avoid overextending itself. Earnings per share has been pretty stagnant and sideways, especially if we exclude the COVID period. Free cash flow per share has been growing nicely over the past few years. Both the earnings per share and sales growth charts show a lot of volatility, but this is mostly still tied to the aftermath of COVID and the search for a clear direction since then. The company regularly engages in share buybacks, which is certainly a positive sign for long-term investors. It's also worth noting that the total sales chart appears to be finally turning upward again. Return on equity and return on invested capital are still at acceptable levels, but ideally it would be good to see these consistently above 10% and 8% respectively. The operating and free cash flow margin charts look much better, with the company performing well above minimum expectations over the past decade. There are no major concerns regarding debt. In my view, management is handling it responsibly. However, the interest coverage chart is less reassuring. Over the past 8 years, only the COVID-related revenues pushed it above the expected level. The company is currently available with a starting dividend yield close to 7%, and the most recent dividend increase was 2.4%. It holds a solid A credit rating, which is considered strong. However, if the company is unable to grow its revenue, this dividend policy may not be sustainable in the long term. That said, the stock still appears significantly undervalued at current levels. Let's start with the numbers. For Q1 2025, Pfizer reported revenue $13.7 billion, down 6% year over year. Non-GAAP EPS $0.92, actually up 10%. GAAP PS $0.52, down 5%. The revenue decline? Mostly tied to fading COVID-related revenues, Paxlovid, Comirnaty. Some areas like Vyndaqel and Comirnaty still contributed positively. According to CEO Albert Bourla, Pfizer is laser-focused on improving R&D productivity, driving profitability, optimizing capital allocation. Their key therapeutic focus remains oncology, immunology, vaccines, and internal medicine, with more integration of digital tools and AI to improve outcomes. Pfizer sees 2025 as a big year for pipeline catalysts. 4 regulatory decisions expected, like RSV vaccines, lymphoma treatments, 9 phase 3 readouts, new programs kicking off in areas like migraine, Nurtec, oncology, breast, prostate, lung cancer, C. difficile vaccine, weight loss drugs, danuglipron. Dividend remains solid, no cuts in sight. Pfizer returned $2.4 billion in dividends in Q1 alone. R&D spend, $2.2 billion this quarter. Debt is under control, leverage at under 3.25 times, no share buybacks planned this year. 2025 EPS guidance, $2.80 to $3. Revenue guidance, $61 to $64 billion. Pfizer is running a $7.2 billion cost savings program through 2027. They plan to realize $4.5 billion of this by the end of 2025. The goal, improve margins, protect profitability. Positives, solid dividend and cash flow, more focused and disciplined R&D. Oncology, immunology, vaccines offer credible long-term potential. Cost-cutting on track, margins improving. Negatives, COVID-related revenue is mostly gone and hard to replace. US Medicare pricing changes, IRA adding pressure. Growth looks flat for now, not a quick recovery story, facing generic and biosimilar competition in key areas. Pfizer is no longer a growth story right now. This stock is for investors who want a stable dividend and cash flow. Except that this will likely be a slow defensive play for a while. But if you're after rapid earnings growth or exciting catalysts, Pfizer isn't the place right now. Right now, this is a classic, slow and steady blue chip. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.